I have spent much of my life studying the ebbs and flows of financial history, tracing the footsteps of those who shaped the art of investing. Among them, one name stands taller than most: Benjamin Graham. To many, he is simply the father of value investing. But to me, Graham represents something deeper, a guiding light in a world where the line between wisdom and folly is often blurred. I want to take you back nearly a century, to a time before computers, before high-frequency trading, before instant access to financial news. A time when investing was not a game of clicks or tweets, but of careful observation, rigorous analysis, and, most importantly, patience. It was in this world that Graham first drew a clear, uncompromising distinction between investing and speculating. A distinction that, remarkably, remains as relevant today as it was then. You may ask, why does this matter? Why should we concern ourselves with definitions from another era? The answer is simple. Markets may change, technologies may advance, but human nature, the emotions that drive fear and greed, remain stubbornly the same. Understanding what separates a true investor from a speculator is the first step toward making decisions that endure, rather than ones that crumble at the first sign of market turbulence. In the next several minutes, I will guide you through Graham's life, his principles, and the stories that shaped his thinking. You will see examples from the Roaring '20s and the devastating crash of 1929, and you will witness parallels in today's world of speculative frenzy. By the end of this journey, you will understand not only what Graham meant by investing versus speculating, but why his timeless lessons can still protect and even empower us in the markets we navigate today. But before we dive into definitions, we must first understand the man himself. For it was Graham's experiences, his triumphs, and his failures that gave birth to these enduring truths that would challenge conventional thinking and redefine the way generations approach the art of investing. Benjamin Graham was born in 1894 in a modest Brooklyn household. His father, a small businessman, instilled in him a respect for diligence and discipline, qualities that would later define his approach to investing. From an early age, Graham was fascinated by numbers, patterns, and the subtle mechanics of business. It wasn't a fascination with wealth itself, but with understanding the principles that made wealth possible, and more importantly, sustainable. He attended Columbia University, excelling academically, and by the age of 20, he had already joined the world of finance. The 1920s were a heady time in America. The stock market was surging, fortunes were being made seemingly overnight, and optimism was boundless. Yet, amid the excitement, Graham observed something troubling. Most of the people buying stocks were doing so not based on careful analysis, but on speculation, following the crowd or chasing rumors. Then came 1929. The market crash was swift and merciless. Investors who had been riding the wave of speculation lost everything. Graham, who had always emphasized rigorous analysis and caution, watched with both horror and clarity. The devastation revealed an unmistakable truth. Investing without understanding, without discipline, is a gamble. And gambling, no matter how tempting, was not investing. It was in this crucible of loss and reflection that Graham's philosophy began to crystallize. He began to see investing not as a game of luck, but as a science of value. He believed that success could be achieved consistently, but only by following principles that prioritized safety, analysis, and reason over hope and emotion.
From these early experiences, the promise of the Roaring '20s and the devastation of the Great Depression, Graham learned a lesson that would define his career. The true investor distinguishes themselves by their preparation, their discipline, and their patience. They do not follow the crowd. They do not chase the latest craze, and above all, they never confuse speculation for investing. But what exactly did Graham mean by that distinction? What separated a careful, disciplined investor from the gambler dressed in a suit? That is the question we will explore next. To understand Benjamin Graham, we must first understand the distinction he drew between investing and speculating. And while today the lines can seem blurred, especially with the rise of fast trading and social media-driven markets, Graham was uncompromising in his definitions. For him, investing was a disciplined activity. It required thorough analysis, careful study of a company's financial health, and a commitment to protect one's principal. Above all, investing involved a margin of safety, buying securities at a price below their intrinsic value, so that even if the world turned against you, the risk of permanent loss was minimized. Investing was measured, rational, and intentional. Speculating, on the other hand, was something entirely different. It was gambling dressed up in the language of markets. Speculators bet on price movements without understanding the underlying value, driven by emotion, rumor, or the hope of quick profits. They sought gains from the crowd's behavior rather than from sound analysis. And as Graham observed throughout his career, this approach often led to disaster. Consider his own words, paraphrased for clarity. The investor's primary concern is the safety of their principal and an adequate return. The speculator, by contrast, is indifferent to risk, hoping to profit from the whims of the market. The implications were profound. To Graham, anyone chasing trends, day trading without analysis, or buying stocks purely because they were hot was not investing. They were speculating. And yet, many could not tell the difference. The allure of quick riches often blinded even the intelligent to the dangers of speculation. We see echoes of this even today. A viral stock recommendation online, a sudden crypto craze, or a tech IPO promising overnight wealth all can tempt the unwary into speculating even while they call it investing. Graham's principles, however, provide a compass. By focusing on intrinsic value, analyzing fundamentals, and always maintaining a margin of safety, the true investor remains protected even when the market veers wildly off course. But the distinction between investing and speculating is not just theoretical. It became painfully real during one of the most dramatic periods in financial history, the crash of 1929. And it is there, amid chaos and ruin, that Graham's lessons come alive. The year was 1929, and the American stock market was soaring higher than anyone could have imagined. Everywhere, people were caught up in the euphoria. Brokers called it a new era of endless prosperity. Ordinary citizens, many with no financial training, were buying stocks on margin, borrowing money just to ride the wave higher. The air was thick with optimism and with danger. Graham watched it all unfold with a careful, almost clinical eye. He had studied the financial statements, evaluated the companies, and understood their true worth. He saw the discrepancy between the stock prices and the underlying value of these businesses, and he knew what was coming. Then came October, and with it, the collapse. Stock prices plummeted, fortunes evaporated overnight, and panic spread like wildfire. Investors who had speculated without analysis lost everything. Banks failed, dreams shattered, and the illusion of easy wealth vanished.
But those who followed Graham's principles, those who bought only when there was a margin of safety, those who focused on fundamentals rather than speculation, were not swept away entirely. They suffered, yes, but they were prepared. They had built a buffer against disaster. While the crowd panicked, the disciplined investor survived. This was the lesson Graham wanted the world to understand. Investing is about preparation, not prediction. Speculation might offer the thrill of rapid gains, but it carries the risk of total loss. Investing, when done properly, is steady, rational, and resilient, even in the face of catastrophe. And yet, the story doesn't end with survival. Graham also saw opportunity in the chaos. The crash left many undervalued stocks, offering a margin of safety for those willing to act wisely. He recognized that the true investor must not only avoid loss, but also seize the rare chances that arise when fear grips the market. But to grasp the full depth of Graham's philosophy, we must examine the principles that guided him, principles that continue to distinguish the disciplined investor from the speculator today. Benjamin Graham's wisdom was not simply a set of rules. It was a framework for thinking about risk, value, and human behavior. At the heart of this framework were a few core principles, each designed to protect the investor from the temptations and dangers of speculation. The first and most famous is the margin of safety. Graham believed that every investment should be purchased at a price significantly below its intrinsic value. Think of it as a buffer against uncertainty, a cushion that protects you if the world turns against your expectations. It's the difference between careful preparation and reckless hope. Without it, even the smartest analysis can be undone by unforeseen events. Closely tied to this is the concept of intrinsic value. Graham urged investors to look beyond the stock price, the number flashing on a ticker, and understand the true worth of a company based on its assets, earnings, and future potential. Price alone is meaningless without context. Only by assessing value can one distinguish investing from speculation. Then there is market psychology, a factor Graham observed with the precision of a historian. He knew that markets are swayed by fear and greed, often moving far beyond what is rational. Speculators chase trends and panic at setbacks. Investors, by contrast, study the fundamentals and remain steady, even when the crowd is irrationally exuberant or paralyzed by fear. Patience, discipline, and rational thinking were his quiet but indispensable allies. Graham believed that investing is not about the thrill of action, it is about restraint. Often, the best investment decision is doing nothing at all, waiting for the right opportunity to present itself. To illustrate, imagine a company with solid earnings and strong assets, but its stock is selling at a fraction of its intrinsic value after a market panic. The speculator shuns it, fearing more losses. The true investor sees a rare opportunity, a margin of safety, and acts calmly. This is the timeless difference Graham championed. The investor acts with knowledge and caution. The speculator acts on emotion and hope. But even the most disciplined investor faces choices. Graham distinguished between types of investors, each with their own approach and responsibilities, a distinction that can prevent even a thoughtful person from crossing the line into speculation. Benjamin Graham understood that not all investors are the same. Some seek safety and simplicity, while others are willing to take calculated risks to achieve higher returns. To guide them both, he drew a distinction between defensive investors and enterprising investors, but he insisted that neither should ever cross into speculation.
The defensive investor is cautious, disciplined, and focused on preservation of capital. They seek steady returns, prefer high-quality bonds or established stocks, and avoid unnecessary risks. Their goal is not to beat the market every year, but to avoid permanent loss and enjoy moderate, reliable gains. In Graham's view, a defensive investor could thrive without obsessively monitoring the market, as long as they adhered to sound principles. The enterprising investor, on the other hand, is active, analytical, and willing to devote time and effort to uncovering undervalued opportunities. They study financial statements, assess intrinsic value, and are prepared to act when the market misprices a security. But even this investor operates under strict rules. Without analysis or a margin of safety, they too would be merely speculators in disguise. Graham's genius lay in showing that investing is not one size fits all. Whether defensive or enterprising, the defining factor is discipline and rationality. The difference is intention, not style. A defensive investor may never make spectacular gains, but they are protected. An enterprising investor may profit more, but only if their work is grounded in principle, not chance. I recall a story Graham often shared from his own career. He had once advised a cautious client to focus on high-quality bonds and established companies, steering them away from the market frenzy of the 1920s. Meanwhile, he himself analyzed undervalued stocks, carefully identifying those with hidden potential. Both approaches were valid, but both required patience, rigor, and a clear line separating investing from speculation. Even today, these distinctions are crucial. In a world of fast trading, algorithmic strategies, and viral investment trends, many believe they are investing. Yet without discipline and a margin of safety, they are no different from the speculators Graham warned us about. And yet, Graham's teachings go beyond definitions and categories. He also offered lessons that many would find counterintuitive, insights that challenge conventional wisdom, even for seasoned investors. Benjamin Graham's wisdom was full of insights that, at first glance, seem counterintuitive. Perhaps the most striking is this: sometimes the best action for an investor is to do nothing at all. In a world obsessed with constant activity, he reminded us that restraint can be far more profitable than impulse. Markets do not demand attention every day. In fact, acting without reason often leads to loss, not gain. Another lesson that surprises many is Graham's definition of risk. Today, people often equate risk with price volatility, the daily ups and downs of a stock. But Graham saw risk differently. True risk is the chance of permanent loss of capital. Price fluctuations, he argued, are irrelevant if you are investing with a margin of safety and understanding the intrinsic value of your investment. The market may swing wildly, but a disciplined investor remains calm, anchored by analysis rather than fear. Consider his observations during market bubbles, both in his time and in modern parallels. He saw investors rushing into hot stocks, convinced they were missing out, only to face devastating losses when the frenzy ended. He also saw opportunities hidden within panic, where undervalued stocks could be acquired at a discount. These lessons teach us that value often hides where others see danger, and speculation often thrives where discipline is absent. Even today, we witness the same patterns. A viral stock, a hyped cryptocurrency, or a trendy tech IPO draws crowds in hope, ignoring fundamentals. The disciplined investor, however, looks beyond the noise, guided by Graham's principles. They understand that long-term success comes not from chasing excitement, but from careful, rational choices. An approach that may feel slow, even boring, but ultimately rewards patience and wisdom. And yet, even the most disciplined investor's journey is shaped by pivotal moments, turning points that test their understanding, refine their principles, and deepen their commitment to true investing. Benjamin Graham's journey was not a straight path. His thinking evolved through a series of pivotal moments, turning points that tested his ideas and sharpened his philosophy. These were the experiences that separated theory from practice and speculation from true investing.
The first major turning point came with the publication of Security Analysis in 1934, co-authored with David Dodd. This was more than a book. It was a manifesto for rational investing. Graham laid out, in painstaking detail, the methods for analyzing a company's financial health, assessing intrinsic value, and protecting oneself with a margin of safety. It was a guidebook for investors who wished to act with intelligence rather than impulse, and it set the standard for generations to come. The second came from observing the markets after the 1929 crash. He realized that panic and irrationality were constants of human behavior. Investors' emotions could swing prices far from intrinsic value, creating both danger and opportunity. Graham's insight was revolutionary. Markets are not always rational, but disciplined analysis allows one to profit from their irrationality rather than be destroyed by it. A third turning point occurred in his mentorship of Warren Buffett, a young student who absorbed Graham's teachings with unparalleled focus. In guiding Buffett, Graham distilled his lessons further. Investing was as much about character and temperament as it was about numbers. Discipline, patience, and emotional control were as critical as any financial calculation. Finally, Graham's later work emphasized the distinction between defensive and enterprising investors, refining his ideas for different types of market participants. He understood that investing is not one size fits all, but the principles, analysis, discipline, margin of safety, remain constant. Through these turning points, one truth became undeniable. Speculation may tempt with the promise of quick riches, but investing endures because it is built on knowledge, patience, and rational judgment. Graham's experiences remind us that every investor faces tests, and it is through these trials that the difference between investing and speculating becomes clear. Yet even with these insights, Graham still offered lessons that many find surprising. Principles that challenge the way most people think about risk, action, and opportunity. Though Graham lived in a world of ticker tapes and ledger books, his lessons resonate profoundly in today's financial landscape. The instruments have changed. Stocks trade electronically, cryptocurrencies rise and fall at dizzying speeds, and social media can drive market frenzies, but human behavior remains remarkably consistent. Greed and fear still dominate, and speculation continues to tempt the unwary. Consider the tech bubble of the late 1990s or the more recent surges in meme stocks and cryptocurrency. In each case, investors were lured by the promise of rapid gains, often ignoring fundamentals. Graham's voice, if we could hear it today, would caution, these are the playgrounds of speculators, not investors. True investing requires analysis, patience, and a clear-eyed view of intrinsic value. Yet Graham's principles also reveal opportunity amid chaos. When fear grips the market and prices fall far below intrinsic value, disciplined investors can act with confidence. The same margin of safety that protected investors during the 1929 crash and the Great Depression remains a shield and a guide today. It reminds us that investing is not about following trends or chasing headlines. It is about thoughtful, informed decisions that prioritize preservation of capital and long-term growth. Modern tools, financial statements online, real-time news, and sophisticated analytics make Graham's methods more accessible than ever. But the challenge is timeless: human psychology. We must guard against impulsive decisions, resist the siren call of speculation, and cultivate the temperament that Graham emphasized: patience, discipline, and rationality. In every era, the line between investing and speculating remains. Graham's teachings illuminate that line clearly, and for those willing to follow his principles, the rewards are not fleeting excitement, but enduring, reliable growth. A legacy that transcends markets, time periods, and the noise of speculation. But after decades of study, experience, and reflection, what is the ultimate takeaway? What should every investor carry forward from Graham's life and work? The answer lies in one final segment: the resolution of his timeless truth.
As we reach the end of our journey through Benjamin Graham's life and teachings, one idea stands above all others. Investing is disciplined, informed, and patient. Speculation is impulsive, uncertain, and emotional. This distinction is not just academic, it is the foundation of financial survival and success. Graham's life teaches us that the market will always tempt us with the illusion of easy riches. It will reward those who act on emotion and punish those who ignore fundamentals. Yet it also offers rare opportunities for the disciplined investor, who approaches each decision with analysis, patience, and a margin of safety. The practical lessons are clear. Always evaluate the intrinsic value of an investment. Never ignore the margin of safety, and recognize that risk is not short-term volatility, but the potential for permanent loss. Be mindful of your temperament, resist the crowd's impulses, and remember that sometimes the wisest action is restraint.
In today's world, fast-paced, information-saturated, and often irrational, Graham's wisdom feels almost revolutionary in its simplicity. It reminds us that the principles of investing do not change with the times, only the tools and instruments do. By internalizing these lessons, we not only protect our capital, but we also cultivate the mindset that allows wealth to grow steadily and safely. So whether you are a defensive investor seeking stability or an enterprising investor searching for undervalued opportunities, let Graham's timeless truth guide you. Invest with knowledge, discipline, and patience, and never confuse speculation with investing. In the end, the true investor is calm when others panic, thoughtful when others rush, and deliberate when others gamble. That is the legacy Benjamin Graham left behind, a beacon of rationality and wisdom in a world forever tempted by the siren call of speculation. And it is a lesson that, if embraced, will endure far beyond the next market cycle, carrying us toward financial decisions that are both safe and sound.